Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss big taxes versus little taxes. Specifically, I'm going to chat about what is the big tax and the little tax, 2 common strategies to minimize the little tax, 4 advanced strategies for high net worth estates, potential drawbacks and pitfalls to planning for the little tax, your 3 potential estate beneficiaries, the big tax, and 3 ways retirees can minimize its impact, and lastly, a few action items for you to consider. So, big tax versus little tax, what am I referring to? Well, big tax is a reference to estate tax, or the income tax liability at death on the taxable portion of your estate, or that of the last surviving spouse. Given the highest marginal income tax rates are over 50% in most jurisdictions in Canada, this is why I call it the big tax. The next is the quote-unquote little tax, also applicable at time of death, which are probate fees. These are charged in most provinces and territories and are generally less than 1%, other than BC, Nova Scotia, and Alberta. Both taxes I will be discussing today, the big tax and the quote-unquote little tax, are in direct reference to estate planning. So things like the structure of your will, joint ownership on properties and investment accounts, trusts, and more. When most people think of estate planning, they are primarily concerned with 2 things. How will my assets be split amongst my beneficiaries? And how can I minimize the amount of tax that is paid when I pass away? When you get down to brass tacks, you have to ask yourself this question. Who do you want to benefit the most from your estate? And there are only 3 options. Number 1, your intended beneficiaries. Number 2, a charity of your choice. Or number 3, the Canada Revenue Agency. Through proper planning, we can address these concerns and help to disinherit the CRA as much as possible. So one pitfall that we often see is the desire for individuals to spend a bit too much energy focusing on the little tax, probate fees, without grasping the impacts this kind of planning will have on the big tax. So let's start there. Now, granted, there are a number of probate planning strategies that may be considered. For most Canadians, implementing probate planning strategies are often done outside of the will, and often do not result in a significant saving. Regardless, let's discuss 2 very simple strategies along with their potential downfalls and risks, and then briefly introduce 4 advanced strategies for high net worth estates. So one of the most common strategies is adding joint owners to your assets. So things like vacation properties, non-registered investment accounts, or even bank accounts. Now, if the intent here is to have these assets bypass probate, this may be achieved via this strategy. However, there are significant downfalls to this that are often overlooked. First, the government has recently ruled that these types of arrangements, where beneficial ownership is separate from legal ownership, are now considered bare trusts, which require a T3 tax filing. If not filed annually and on time, this could result in penalties that reach into the thousands. Second, the day the joint owner was added to the account, a portion of the account or property will be deemed disposed of for tax purposes. So as an example, if you added your son or daughter to the title of a vacation property, the proportionate amount of ownership will be considered a deemed disposition and taxable that year as a capital gain. So as an example, say you have a vacation property worth $1 million with an original purchase price of $500,000. Today, you decided to add your child to the property as joint tenant with right of survivorship. In doing so, you would have triggered a $250,000 capital gain. Assuming you had no other capital gains that year, you would only be subject to a 50% inclusion rate, rather than the 2/3 inclusion rate on capital gains over $250,000. So if we assume a 45% tax rate, this change to joint ownership, adding your child, will have triggered $62,500 in tax payable that year. The third downfall to adding a joint owner is that the final outcome of your estate after your passing may not be in line with your true intent. In the same example I just gave you, instead of one child, assume you had 2 children, but you still only named one child to the property as joint owner with right of survivorship. The vacation property would bypass the will, not pay probate. However, the full property would now be in the ownership of just one child after your passing. Was that your intent? The other very common strategy for probate planning is naming direct beneficiaries on your plans and policies. So things like your RRSPs, TFSAs, RIFs, life insurance policies, and more. Now, granted, if you have a spouse, naming them as a direct beneficiary makes sense. However, you should take extra care with this probate planning strategy when naming non-spousal beneficiaries. One common pitfall with naming direct beneficiaries are the impacts it can have on social benefits. If you have a disabled beneficiary, naming them as a direct beneficiary may disqualify them from public programming, social benefits, and disability incomes. Next is the potential horrendous tax consequences and family strife it can cause. For example, if you name a non-spousal direct beneficiary on a RIF account, there is still tax to be paid by the estate on that RIF. And if you are an executor of a will, this can be especially troublesome if the estate does not have enough cash to cover the tax bill. Here's an example so you get an understanding of what I'm talking about. Say you have a $1 million RIF account, no spouse, and decide to name your 2 adult children as direct beneficiaries on the account with the intent of saving money on probate fees. At death, assuming a 50% marginal tax rate, your estate would owe $500,000 in tax to CRA. But because you named your 2 adult children as direct beneficiaries, the money bypassed the estate, and each adult child would have received the full $500,000. If you were the executor of this estate, and there was not enough other assets or cash to cover this tax liability, you would need to go back to each of the adult beneficiaries and ask them to pony up $250,000 each to cover their deceased parent's tax bill on the RIF. This is where things can get ugly. As you can see, adding joint owners to your assets or designating direct beneficiaries can have unintended consequences. It's important to work with a professional who understands these nuances and can help to build a holistic estate plan that factors in legal, tax, and your unique family dynamics. Now, there are 4 other advanced strategies that I will very briefly introduce as they are quite complex. In order for these to be worthwhile, the cost of implementing these strategies, along with potential ongoing costs, must be significantly lower than the potential future probate fee. Other than the noticeable costs, these strategies may also help to avoid the challenge of your will and help keep your affairs more private. Now, as I have mentioned, these strategies are generally applicable to high net worth estates and often include the ownership of private corporations. For all of these strategies I'm about to mention, please consult an estate lawyer before considering any form of implementation. The first strategy is an insurance trust. Now, while naming direct beneficiaries on an insurance policy will not attract probate, there may be a concern where potential inequities could result in naming direct beneficiaries. If this is the case, an insurance trust may help to address this concern altogether. The second strategy is an alter ego trust and joint spousal or common law partner trust. These are most commonly used by individuals who want their non-registered assets to be distributed outside of probate. Both of these strategies may assist in reducing probate fees, but they will not in any way reduce income tax. This is where you need to be aware of potential drawbacks of this strategy that could make the potential probate planning benefit null and void. Please get in touch or speak with an estate lawyer to learn more. The third advanced strategy is having multiple wills. This concept involves distributing any assets that must be probated in one will and distributing assets that do not need to go through probate in another will. An example of where this may be considered is in the case where there are real estate and investment accounts that cannot be distributed without letters of probate and shares in a privately held corporation that often do not need to go through probate since the directors of the corporation are usually close family members or colleagues who would be willing to transfer the shares to their heirs without requiring formal letters of probate. Be sure to speak with your lawyer about this strategy as it is not permitted in some jurisdictions and must be drafted in a specific manner to be effective. The fourth and last advanced probate planning strategy is transferring assets to a holding company. Probate fees are generally assessed against the gross value of an estate, less the value of any debts secured by real property. Unfortunately, personal debts related to the purchase of a business usually will not reduce the value of that business for probate purposes. However, if investments or business assets are transferred into a holding company and the corresponding debt is also transferred to the holding company, then the value of the assets for probate purposes will effectively be reduced, since the net value of the shares of the holding company will be the value of the assets less the amount of debt. Complex, I know. Speak to your advisor before transferring any assets to a corporation, as the transfer must be done in a very specific manner to avoid triggering capital gains. As you can tell, these four strategies are quite complex, and it is extremely important you obtain professional advice before implementing. For more information, please get in touch to better understand what structure makes sense for your estate and wealth transfer plan. At the end of the day, you need to be sure all of this probate planning is justified when factoring in all the potential downsides. More often than not, focusing your energy on minimizing the big tax, income tax payable by your final estate, will be much more impactful. Think about it. You may save a few $1,000s in probate fees through proper planning, but you are likely to pay hundreds of thousands, if not millions of dollars in income tax on your final estate if not planned for properly. So here are 3 strategies for you to consider that could have a tremendous impact on your final tax bill. Number 1, drawing money out of your registered accounts sooner than later in retirement. This strategy involves managing retirement income and taxation throughout retirement to optimize your tax brackets while you're still alive. This strategy aims to pay a smaller amount of tax now to avoid a potential 50% tax bomb that can rock your final estate. The second strategy is to maximize spousal income splitting opportunities. This could mean taking more funds out of a spousal registered account that is substantially larger than the other spouse in the early years of retirement. You would do this as a means to help manage income in the RRSP and Lira before you're forced to convert them to a RIF at age 71. Household income will remain the same, while household tax will be reduced. You will now have greater flexibility, and tax minimization is now possible. That large mandatory withdrawals in your RIFs at age 71 won't cause clawbacks or bump you into a higher tax bracket. The last strategy is to ensure you are maximizing your TFSA accounts annually. This can often be achieved by utilizing the additional tax paid dollars generated by the first strategy. Now, there are a number of other tax minimization strategies we consider for clients on an annual basis, but these three are a great start if you're putting together your own retirement income plan. For all of you out there who have private corporations and holding companies, in the very near future, I will be doing an episode focusing on tax planning strategies to help you out. So if you haven't done so already, hit subscribe and stay tuned for more. In the meantime, if you want to discover our fundamental retirement plan process, where we help to build estate plans, retirement income plans, and more, please check out our website. Okay, so that does it for today. Here are your action items for today's episode. If you've been focusing on probate planning for yourself or an aging parent, be careful. The decisions you are making today may have unintended consequences. Please seek some guidance if you're unsure. Number 2, with the changes in the capital gains legislation, the importance of understanding your estate final tax bill has never been more important, especially for those of you who own a vacation property. Please check out episode 3 of the podcast where I dive a little bit deeper into this subject. Lastly, enjoy the rest of your summer. Time has an eerie habit of flashing before our eyes. When fall comes around and things start to slow down, get in touch to help optimize your estate and minimize your tax. Okay, so that'll do it. For all the links and resources, check out retiringcanada.ca. If you're enjoying the show, please leave us a review in your favorite podcast app. Be sure to sign up for the weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.